Very pleased to welcome Professor Richard Gershon here with us today. He's our faculty at the University of Mississippi Law School. He was also former dean at the law school from 2010 to 2015. Before moving to Mississippi, he was the founding dean of the Charleston School of Law. He served as dean of Texas Wesleyan University School of Law in Fort Worth, as well as Stetson University School of Law from 1984 to 1998, and was academic associate dean of the law school from 1988 to 92. Top of that, he graduated from the University of Georgia and BA, as well as got his JD at the University of Tennessee. I'm being from Franklin, Tennessee, appreciate that. And also his LLM in taxation at the University of Florida. So once again, Richard, thank you for doing this and taking time to really answer a lot of really interesting questions, and also as we get to the dynamism of the tax code and how it changes often. So just thank you and welcome.
Clay, it's great to be here. Thanks for including me, and really excited about this program that you're doing, and hope that we can be more involved as we go forward. And you mentioned that I was the founding dean of the Charleston School of Law, and I guess that was my time with entrepreneurship. And I will say to the entrepreneurs out there, sometimes it felt like we were building a football team while the game was going on. We kicked the ball off, and we were excited about that. And then we realized, oh, hell, we need a defense. So, we didn't do anything until we absolutely had to do it. And it's exciting and a thrilling way to start a business. And I was excited to be part of that. But I'm happy to answer your questions. Your students ask great questions. So thank you for having me.
Excellent. And so we'll start with this. And this is a combination of questions from Caden Ryan and Tressa Presley. So when is it a good idea to create an SCorp, a C-Corp, an LLC, or an LLP for a new business?
Well, it's really important to think about the non-tax implications. And really, when you think about forming an S corporation, a C corporation, an LLC, or an LLP, you're really talking about limited liability. And that's really a key. So I think even someone who in a new cottage business where they're putting up their preserves and selling them at a local farmer's market should consider one of those forms of limited liability, because what that will do is it'll mean that the only assets that someone who sues you, or the only assets a creditor could go after, would be the assets in the actual business. And so I don't think people do that soon enough. And then, of course, the choice of entity form is a more complex issue.
And I was going to say, because I know we spend a lot of time, the difference between like a LLC and the ability to raise capital versus like a C Corp. And those are the type of implications you're also alluding to right there.
Exactly.
So what are some of those tax implications now from the different types of structures? Because one thing I did fail to mention was the sole proprietorship, which you alluded to in terms of the liability and unlimited liability there, but from a taxation perspective.
Well, sole proprietorship is what it is, and that means that the person just reports their income on a Schedule C as business income, and they are the entity. So their personal income, their interest on their bank account that's not connected to their business, as well as their business income, will all be put together. But their business income would be reported on a Schedule C. For people forming an entity, they're really, frankly, just two choices from a tax perspective. There's the corporate form, which is taxed as a separate entity, and we usually call that we call it corporate tax, but really it's separate entity taxation. And then there's the pass-through form, which traditionally was partnership, but now can apply to LLCs and LLPs, and does apply to S corporations where the entity itself is not taxable. And I want the students to think about as they form businesses that, frankly, you can change. I mean, you can start off as a pass-through entity because maybe in the first couple of years you have losses that you want to flow through to the owners, and they can take those losses on their own tax return. But as the entity becomes more profitable, if you want to maybe shelter some of that entity in the business itself, maybe you think about forming a C corporation. So as you mentioned, it's a little bit easier to maybe raise capital as a C corporation. So all that's going to depend on the entity itself, what's the best interest. And I will say repeatedly in this interview, don't let the tax considerations, don't let that tail wag the dog, right? Because tax considerations are part of the economic considerations for the entity, but should not be the only consideration.
And to that point, because one of the things that would is the dynamism of the tax code itself. Because I know that I've heard a lot of talk because of the recent tax reforms, I guess back in 2017, 18, when they were talking about the corporate tax rate was greatly lowered, that may be an opportunity for everybody to quote become a corporation. What do you, I mean, what's your perspective on that?
Well, it might have been in 2017 and 2018 when the Tax Cuts and Jobs Act was created, and we reduced the corporate tax rate to 21%, which is pretty low historically. It had been higher than that, as high as 36% at some point. And now we are at a place where, that 21% sounds pretty enticing to someone who thinks about, well, I want to form a corporation. Bottom line is eventually you want to take the proceeds from the corporation, the revenues, the income, and get it back out to the owners, right? The owners are going to have to take a draw at some point, whether they're a corporation, partnership, or whatever. And so if we can have this income tax at a lower rate, 21%, that may be appealing. But we have a new Congress, we have a new president, and there's already proposal that we would increase that corporate tax rate back up to 28%. So you have to be careful in terms of tax because it will change, and politics will play a role.
And to that point, could you allude to a little bit about tax aggressiveness and how that plays in to this dynamic policy that we're facing, and what do you recommend for companies, especially startup companies? Because I know that's a very broad scope of a question I just gave you, but just your insights would be great.
Yeah, I think definitely take into consideration the current tax structure, but realize it can change. And so, bottom line is longer term, what's the best entity to run your business? And I think you look at the non-tax issues really first, which will be a C corporation. For bigger entities, probably is maybe even what you have to choose. You may be kind of stuck in that structure. LLCs give you great flexibility, as do partnerships and limited liability partnerships. They're going to give you greater flexibility longer term. A corporation is going to need a board. You're going to have to report to the state certain things that you may not have to do to as great an extent with one of the pass-through entities. So I say choose the form that works best for your business. Don't let taxes be the reason, because they will change. But definitely think of taxes as a variable cost of running the business. And to the extent that you can work with someone to help you attain your goals but minimize your taxes, you're going to come out ahead. So entrepreneurship is a group project, and you will need to have an accountant and a lawyer work with you as you run your business.
That's a great point about having the other auxiliary professionals working with you too, in terms of getting a more holistic perspective of how that looks. So one just follow-up question on these in terms of organizational forms, in terms of exit strategy. So we've talked to everybody about doing how great, things are going well. So I would like to give you a couple scenarios in terms of exits. The bad exit, of course, would be bankruptcy. And the good exit would be some kind of liquidity event where they're taking money out. Do you have any comment about what form would be best for that, or does it truly contingent upon the situation?
It often is contingent upon the situation, but the problem with corporations, C corporations, is dividends are taxable at the corporate level as revenue when they earn it, and then when they distribute those dividends to shareholders, they're still taxable to the shareholders. So we have two levels of tax. And that was not as big a problem when the corporate rate was 21%. You didn't really get as much of a hit. But if the corporate rate goes back up, and if the individual rates go up, then all of a sudden that double taxation really is, to me, an impediment to thinking about corporate formation as a way to distribute revenues. Partnerships, LLCs, and LLPs, and S corporations, the earnings pass through directly to the owners, or taxed to the owners in the year they're earned. So when those distributions are made later, they're not taxed a second time. So you only have one level of tax at that point.
Excellent. Is there any difference in bankruptcy for the negative side?
Well, yeah, obviously bankruptcy is no fun anyway. So that means your company has failed, and entrepreneurs do fail, as we know, and so one thing is that the forgiveness of debt in bankruptcy is not taxable. So there's actually a positive to that. You know, it's not something you strive for, but you're not going to have to report that debt relief as being taxable. And but all liquidations in general are treated essentially the same way, which is if we're liquidating and we're going to shut our business down, it's treated as a taxable transaction to the corporation and a taxable transaction to the shareholders. Whereas in a non-corporate form, you really are again just going to have that one level of tax.
Excellent. And I was going to say, I really like the point there about bankruptcy is actually, it's one could argue a blessing, and one reason why there's so much entrepreneurship in the U.S. because they do fail, but it's not the end of the day. It's not the end of everything. If you do go bankrupt, you have a chance to recover.
Exactly. It's a fresh start.
Excellent. So going back to the questions. So another question from Tressa Presley. Because state laws vary, what are some complexities that not-for-profit corporations face when expanding from one state to another or even to another country?
It's a great question. And let's talk about not-for-profits generally first, because a not-for-profit is a special kind of corporation. It doesn't have to be a corporation, though. You can have a not-for-profit association. So there are other forms of not-for-profits. But when we talk about a not-for-profit, what we're really talking about is tax-exempt status. Because, for example, the University of Mississippi is a not-for-profit. It's a tax-exempt organization that has to be tax-exempt both at the federal level and the state level. And there are steps that the university had to go through to get that tax-exempt status. And there's certain reporting that has to take place. But it also means the university can raise money through charitable contributions. And those who give money to the university can give money that is deductible. So it's a special kind of entity. But so when we talk about those complexities, we're going to talk about really the formation of the entity itself and the ongoing reporting that has to take place to get this special status. But the University of Mississippi, even though it's not operated as a for-profit entity, if it doesn't make a profit, it's not going to stick around, right? So really, even these not-for-profits, the United Way, the University of Mississippi, churches and other organizations that are not-for-profits do ultimately have to have more revenue coming in than they spend, or they're not going to be around for a while, for that much longer, right? So they can go out of business as well. And so I think it's important to understand that. Now, the complexities in terms of state, and I think it's great that Tressa asked the state question and not just the federal question, because corporations that are not-for-profits you really have duties to both. In Mississippi, if you are a not-for-profit, you have to file with the Secretary of State. You can go on the Secretary of State's website and pull up a list of not-for-profit organizations that have to be registered. All right, so let's say you form in Mississippi, but you also want to be able to raise money and seek charitable contributions in Alabama and Canada. That's going to require you to notify those jurisdictions that you're there, and typically you have to request permission from the appropriate entity. Usually it's the Secretary of State in the United States for each state, that you're there, and you have to then have a registered agent or someone that state can reach out to in the event there's a problem with your entity. So you're typically only formed in one jurisdiction, but to operate in other jurisdictions, whether it's a corporation that is for profit or not for profit, then you have to notify the appropriate authority.
And Richard, to follow up on that, so when you say operate, does that mean like let's stick with the example. I'm here in Mississippi. I have this wonderful United, we'll use something more local, my church here, and I get a donation from, say, state of Washington. Do I have to file with the state of Washington in order to receive that donation, or for the citizen who donated that money from me, whose primary residence is in Washington, do they get to count that on their state income tax at that point?
Great questions, Clay. Yeah, absolutely. Typically, really what's going to happen is that your church organization would be not only exempt at the state level, but also at the federal level. So when the person donates the money from Washington, they would get a deduction on their federal taxes, but they would also then, what happens is states then take those federal deductions and apply them to the state taxes typically. So it would be deductible. But the real question is, did you solicit that directly from that person in Washington, or did they just find out about you and say, I like this church in Mississippi, I'm going to give money to them? That would change the dynamic, because if you're actually actively soliciting in the state of Washington, then you should register with the state of Washington that you are a charitable organization exempt in Mississippi, and they would allow you to work there. Typically, that's pretty easy to do once you notify them. But what happens for charitable organizations is they don't realize they need to do that in the state where they're organized. So, somebody gets tax exempt status with the federal government, and they are a Mississippi charitable organization, but they haven't notified the Secretary of State. They haven't gotten permission with the Secretary of State. You can't solicit funds in Mississippi unless you have that permission from the Secretary of State.
Oh, so let's say you didn't do that. What would happen? Because I just find it so intriguing, because I always thought it was like just a 501c3. You go to the federal level, you take care of it at the federal level, and then the federal would maybe trump the state. But obviously that's not the case here.
Well, it's interesting. Yeah, you usually what happens if you have 501c3 status at the federal level, then the state's going to give you that 501c3. So you got to, you do C3 status. You still have to, you're going to have to let them know. It's the same thing if I operate my business in Mississippi that's not tax exempt, and I haven't gone through the appropriate process of, letting them know who my registered agent is for service of process, which is usually what you have to do. I could get in some minor trouble, but that's usually pretty fixable, right? I mean, it's possible if I keep doing it after they inform me that I need to let them know and need to get their permission, that they could shut me down, and I could have to pay fines. But usually what happens is, because it's typically people who are just unaware they need to do that, the Secretary of State's office will work with you.
Okay, excellent. That's a great answer. Plus, again, hopefully all these things will be taken care of with that more of that holistic team that you got working with you to point these things out as you go forward.
Exactly.
All right. So moving on here, another question from Tressa. What is the distinguishing line for a company that is a for-profit versus a not-for-profit, since some companies seem to exhibit little or both in terms of philosophy?
Great question. And really, the honest truth is the difference between a not-for-profit and a for-profit is tax-exempt status, really, because to get tax-exempt status, you've got to meet certain qualifications, and there's the very highest qualification really is the charitable organization, which is established for scientific, religious, educational achievement, that kind of thing. Like so universities and churches and museums typically are 501c3. And what that really does mean is that they are tax exempt, but also that contributions to them are deductible by the contributor. There are different types of tax exempt entities, not-for-profits. Homeowners associations, for example, can charge fees to their homeowners. Those fees are not taxable to the homeowners association. They're a tax exempt entity, but they're not deductible by the homeowner because they're not considered charitable contributions. And those kind of tax exempt entities, Congress has decided, well, we need to allow them to raise money in a way that typically if you were a corporate entity or a business entity, you're going to have to pay tax on any revenue you receive. But we want the homeowners association to be able to use their entire revenues to actually support the homeowners association. So as long as they're actually doing those kind of things, it's okay. And then they're more, what would almost sort of like lobbying organizations, 501c4s that can raise money to bring awareness. ACLU, for example, does have a political goal. They also have a 501c3 that's connected to it, but they can lobby, they can get involved in politics, and so the revenues they raise are not taxable to them. So the real difference between a for-profit and a not-for-profit is whether they get tax-exempt status or not, to be perfectly honest.
And I like how you brought up earlier to the point about the for-profit and the not-for-profit are basically both trying to stay in business and have profits and to generate revenue to support their missions, what they're trying to do there.
Exactly. I almost feel like it would be easier for people to understand if we talked about taxable entities and tax-exempt entities.
Yeah, that's a great way of putting it. And speaking of, so the follow-up question to that is conversion back and forth between these two entities. And is that possible or is it not?
It's really hard. It typically won't happen. In fact, if it happens, it would be from a taxable entity to a non-taxable entity. Because if you're a tax exempt entity, then part of the way you get tax exemption is you have to assure the government, the federal government, that as part of this tax exempt status, that if you ever liquidate, your assets have to go to another tax exempt entity. They can't go to individual shareholders. They can't go to a taxable business. So that would make it very difficult to make that transition.
And I heard that's actually very difficult sometimes for these not-for-profits to actually exit themselves because they still have assets that they have a difficulty getting to moving. We'll put it transferring out. Yeah,
exactly. So what they got to do is find another tax exempt entity that will take those assets essentially. Otherwise, so the whole point of a tax exempt status is no individual can benefit directly from the work of the tax exempt entity. So I can't form a tax exempt entity, for example, that would that's going to supply college education for my child. I can't do that, but I can set up a scholarship organization that people can apply to that I don't know, that I've never really thought about, who can apply, and if they meet certain criteria, then the scholarship could go to them. So that would be all right. That could get tax exempt status. So whole different kind of entrepreneurship in a way. But I think, if it's all right, Tressa's question goes on to ask about these benefit corporations. And benefit corporations are for-profit corporations that do some good, right? They're kind of part of their mission is to do good. And I always think of I'm a big fan of Shark Tank, which, really for an entrepreneurship class. And I'm fascinated by it. And I think Bombas, I actually think they made a pitch to Shark Tank. I'm not 100% sure about that, but the Bombas Stock Corporation, part of their deal is, they'll sell stocks, but they'll sell socks, not stocks, but they will donate some socks to people as well. So you buy a pair, they'll donate a pair. And to me, that's what a benefit corporation would do. They're not tax exempt, they're a taxable entity, but they want to do some good.
And I do know that the benefit corp, they're fairly new organizational form, and they're only in so many states. I want to say 35 off the top of my head right now. But I know this great state of Mississippi does not have a benefit corp form. And do you know if that were to happen or if there's any, I know that you're not lobbying for any of these things either, but have you heard of any movement in this area?
No, unfortunately, we tend to kind of focus on other stuff, and that's not one of them. So, there's talk about getting rid of the state income tax, for example, and I don't know that that's going to happen. I really just don't. And we could have that's for a whole nother discussion, but I don't think it would be a good idea either, frankly. It would certainly hurt retired people, for example, but surprisingly, but that would be a really bad thing for people who are retired. So, that's just a whole different issue. There are a lot of people lobbying out there saying, no, wait a minute. It sounds like getting rid of taxes is a good idea, but it's usually often not.
That's a great point there. Because coming from Tennessee, where they don't have the state income tax, but they always talk about the sales tax, and they continue to raise the sales tax. It creates that other issues, as you've alluded to there.
Well, in fact, in Texas, I lived in Texas for a while, and Florida. Florida has entertainment taxes and all kinds of stuff, hotel taxes. And that's where they get their revenue, the state lottery. Texas property taxes. My property was lower value in Texas, but it was much higher tax. So, that there's always a result. And the reason I said it would hurt retired people here is it would raise the sales tax, probably raise property taxes. Right now, retirement income is not taxable. So there's no income tax on retirement income. If somebody's living on a fixed retirement income, they're not paying the state income tax. But if you raise their property taxes and their sales taxes, you're actually going to hurt a retired person by doing that.
And that's a great point, because inevitably there's some kind of, and I wouldn't say shell game, but it's a shell game where they're trying to find taxes somewhere else where it then pops up over there. So
exactly.
Going back to the questions, another question from Tressa. Structural barriers in the tax code that put entrepreneurs at a disadvantage.
Yeah, it's a great question. And it's a really, it would take longer than a half hour to answer all the structural barriers. But I think the real structural barrier is the code is not neutral. And so the code encourages some behaviors and discourages other behaviors. And so because of that, entrepreneurs have to navigate which behaviors are encouraged, and they may go in the direction of the behaviors that are encouraged by the code and stay away from the behaviors that are discouraged by the code, even though their business model might be better benefited by ignoring that, right? So and the code is complex. I don't think it's hard. I think it's complex. I think there's a difference. And I think when you talk about fairness, I kind of joked that the Soviet Union was really kind of fair because they just, you made it, they took it, right? That's kind of at least the concept people had. But if we want fairness, we got to treat all the complexities of our various transactions differently. And so it's very hard to look at a transaction and somebody gets $1 million, from someone else. How is that taxed? Well, it really depends on the circumstance. If it was a gift, they're not taxed on it. If it was inherited, they're not taxed on it. If it was salary, the whole thing is taxed. If it's somebody's buying property from them and they paid $110 million for that property, and the person gave them $100 million for it, they're going to lose money and they're going to have a loss. So we have to have a code that looks at all the complex transactions that people engage in and the different ways we make money and engage in property. And to be fair, then the code has to try to differentiate those different kinds of transactions. So the barrier really is the complexity of it as well.
And also, once again, I go back to your earlier point. It's the dynamism of the tax code too, because I know we just had a change of presidential doctrine, if we want to call it that, or dogma per se, and how they, look at the tax code. We'll put it that way. So that inevitably there are going to be some changes that are going to come about there. And so I love your point about pay attention to the tax code, but also do what's best for the business going forward, and then try to adapt as you go for that point there.
Exactly. And there are tax professionals who you do want to engage in your entrepreneurship that will help you navigate some of those things and plan to best take advantage of what's there in the code. Again, I think if you look at taxes as a variable cost of doing business, you got your fixed costs. There's nothing you can do about those, but your taxes, you can structure your transactions in a way that will minimize your tax burden. And so that, they really are a variable cost. You can say, okay, well, I want to get from point A to point B, and somebody can sit down and tell me what's the most tax efficient way I can achieve that. But if I want to get from point A to point B, and I decide, but I can save taxes by going to point C, which is not even part of my plan, then you miss the boat. I think you missed the point.
That's excellent. Excellent. And so now this is a little bit more of a COVID-19 question here. So we talked about the current tax incentives, and you kind of alluded to this already, but could you talk about the entrepreneur and the tax code related to COVID-19 and all the stimulus packages, and just your opinion on all these things kind of going forward?
Well, I think they are really, this is a unique situation. So it's something that none of us could have ever predicted, and we would not have known exactly what the response would be. And I think it's great that there's been the stimulus, because it helps to keep businesses going, keeps people, with some, have lost jobs, in a better financial position. I think probably we're going to have to pay for it at some point. So that might be higher taxes at some point, and that wouldn't be surprising. And so the proposals really are to impose higher taxes on people in above $400,000. That's what I've seen so far, and I've also seen that there might be increases in the employment taxes. So FICA. So if somebody's making over $400,000, typically they're not paying Social Security after roughly 120,000. That's where it maxes out. But to extend the FICA taxes to higher levels to help pay back some of the cost of doing this, the relief that's been there. And so I do think there are going to be some changes there. In terms of incentives, we're going to see we want people to get back to business. We want people to get back and operate again. So I do think Congress is going to give some incentives in the tax code related not to businesses, but just generally speaking. For example, the first time home buyer credit has been proposed to come back. It was here in 2008 after the last financial crisis. So to encourage people to get back into the home market business, they've talked about that. So there probably will be some credits available to keep people in business and start up. I would just say keep an eye on it. You know about it as much as I do right now, because you can never predict what Congress will do.
That's excellent. And kind of wrap us up here. What is your best advice to someone considering starting an entrepreneurial business?
Don't let the tax tail wag the dog. Do look at the tax consequences. Have a good team. Know your strengths, right? And if you are a great builder with a great idea, know that there are people, though, that you need to have on your team, like accountants and lawyers, to help you navigate the liability issues, the tax issues. So keep that in mind. They'll help you stay out of problems later on, and understand generally what the taxes are, but also look at them as a variable cost. Don't be afraid of taxes either. Don't avoid doing things simply because they're going to be taxable, because ultimately, I always say, give me the money, I'll pay the taxes, right? You want to be profitable. And if that means that part of that is a cost of doing business is taxation, that's fine. What you got to do is look at then how that affects your net bottom line. Are there other ways I could have structured this transaction to even lower my taxes? Then go that way. But don't avoid making income simply to avoid taxes. That would be a mistake.
Tell you, Richard, this has been fantastic. Do you have any closing advice on anything besides come see you whenever anybody has any tax problems? Or
well, they could certainly ask questions. Take advantage of the whole university, right? Definitely. If you have questions, this has been. I'm happy to do this. But if any of the students want to email me, they know my email address. If there's, because there are resources available that I'm happy to share. Articles on entrepreneurship and for the tax side of entrepreneurship. I taught a 3-hour class in this, so on taxes. So this is just the headline news. But don't be afraid to pick somebody's brain. Find a mentor. Ask questions. Whatever it happens to be, whether it's about tax or anything.
I tell you, that's a wonderful answer. And as part of our entrepreneurial ecosystem, we thank you in the law school for helping out our student and faculty and staff entrepreneurs so much as you do and helping build our community here. So thank you, Richard, for taking your time to do this and answer these many questions. Also, I'd like to thank Caden and Tressa for the excellent questions they offered. And once again, Richard, thank you so much.
My pleasure.